Last week, a Substack article crashed the stock market. Not earnings, not the Fed, not a war, a blog post. The S&P 500 dropped over 1%. Mastercard fell 4%. Visa fell 5%. DoorDash, American Express, all down in a single session because of a thought experiment. The article was called The 2028 Global Intelligence Crisis. It was written by Citrini Research, a finance Substack run by a former Citadel analyst. And the thesis was simple. What if AI works? Not what if it fails, not what if it's overhyped. What if it does exactly what big tech says it will, and the economy wasn't built to survive that? By the end of this video, you're going to understand the four-step chain reaction that a single blog post mapped out, and why Wall Street couldn't explain why it wouldn't happen. Here's the setup. For the entirety of modern economic history, human intelligence has been the scarcest and most valuable resource on Earth. Every salary you've ever earned, every mortgage you've ever been approved for, every dollar of consumer spending in the economy, it all traces back to one thing. Humans are hard to replace. Companies pay white-collar workers $25, $50, $100 an hour because the work requires judgment, analysis, communication, things machines couldn't do. And that money doesn't disappear. It gets spent on rent, on groceries, on cars, subscriptions, vacations. It circulates. As white-collar workers make up 50% of U.S. employment, and they drive roughly 75% of all discretionary consumer spending. That's not just a workforce. That's the engine of the entire economy. Now here's the question the Citrini report asked. What happens when that engine gets replaced? Not gradually over decades. Not theoretically. What happens when AI gets good enough, fast enough, that companies start replacing white-collar workers at scale? Yes, the report laid out a four-step chain reaction, and each step makes the next one inevitable. Step 1. The layoffs. In late 2025, agentic AI tools took a step function jump in capability. Not chatbots, not assistants. Autonomous agents that could write code, draft legal briefs, manage projects, analyze data, and handle customer support without human oversight. Companies noticed. The math was simple. A junior analyst costs $75,000 a year plus benefits, plus office space, plus management overhead. An AI agent costs a fraction of that, runs 24/7, doesn't take vacation, doesn't need health care. The layoffs started exactly as you'd expect. First, the easy targets, customer support, data entry, basic analysis. Then it moved up. Junior associates at law firms, entry-level financial analysts, marketing coordinators, project managers. What entire departments restructured around 3 people and a suite of AI tools doing the work that 20 people used to do. Corporate earnings looked incredible. Margins expanded. Productivity soared. And the stock market loved it. By October 2026, the S&P 500 hit 8,000. The Nasdaq broke above 30,000. Investors called it the greatest productivity revolution in history. But here's what nobody priced in. Step 2, the spending collapse. Every person laid off in Step 1 was also a consumer in Step 2. Those junior analysts were paying rent. They were buying cars. They were eating at restaurants, paying for streaming services, booking flights. When their income disappeared, so did their spending. And it wasn't just the people who lost their jobs, it was the people who kept them. When your coworker gets replaced by an AI, you don't celebrate. You cut your spending. You stop buying things you don't need. You start saving. Just in case. Economists call this a confidence shock. Even employed workers reduce discretionary spending when they perceive structural job insecurity. And AI wasn't perceived as a temporary disruption. It was perceived as permanent. The Citrini report coined a term for what happened next. Ghost GDP kept going up. Officially, AI was producing more output than ever. Companies were more productive. The national accounts looked fine on paper. But machines spend $0 on discretionary goods. They don't buy coffee. They don't pay rent. They don't book vacations. The output was real. The economic circulation was fake. Ghost GDP. Output that shows up in the national accounts but never enters the real economy. And this is where the feedback loop starts. Step 3. The death of friction. This is the part that surprised Wall Street. For decades, while some of the most profitable companies in America have been built on one thing: human inconvenience. Every time something takes you too long or costs too much effort to optimize, a company exists to monetize that friction. And you pay for it. Uber takes a 30% cut because you don't want to find a taxi. DoorDash charges delivery fees because you don't want to drive to the restaurant. Mastercard and Visa charge merchants 2 to 3% on every transaction, and that cost gets passed to you in higher prices. These are toll booths, and they exist because humans accept bad prices to avoid more clicks. AI agents don't accept bad prices. They optimize ruthlessly, 24 hours a day, for fractions of a penny. The Citrini report described a scenario where AI agents started routing transactions away from traditional payment networks, away from Visa, Mastercard, and American Express, and onto stablecoin rails, Solana, Ethereum, where settlement is near instant and the transaction cost is effectively zero. No interchange fees, no 2 to 3% toll. The entire business model of the payment industry, gone. And it wasn't just payments. Every company built on monetizing human friction started to crack. Travel booking platforms, insurance brokers, real estate agents, financial advisors. As any business that existed because humans were too busy or too uninformed to optimize their own decisions. The report called it the death of friction, and it meant that even the companies that survived the layoffs were losing their revenue models. This is why Mastercard dropped 4%, why Visa dropped 5%. Why DoorDash sold off, not because of a recession, because of a future where their entire business model becomes unnecessary. Step 4. The financial system breaks. This is where the Citrini report went from uncomfortable to terrifying. The U.S. mortgage market is worth $13 trillion, and every one of those mortgages was approved based on one assumption: that the borrower will remain employed at roughly their current income level for the duration of the loan, for 30 years. That assumption held for decades. White-collar workers with good credit scores, stable income, professional careers, these were the safest borrowers in the system. A 780 FICO scores, prime mortgages, the bedrock of the housing market. But if AI structurally impairs white-collar income, not temporarily, not cyclically, but permanently, then the fundamental assumption underneath $13 trillion of mortgages is wrong. And it didn't stop at mortgages. During the AI boom of 2025, investors poured money into private credit, $2.5 trillion worth. A lot of that went into software companies. It leveraged buyouts of SaaS businesses at valuations that assumed recurring revenue would keep recurring. But when AI started replacing the products those SaaS companies sell, when an AI agent can do in seconds what enterprise software was charging $50 a month per seat to do, those recurring revenues stopped recurring. The private credit marks disconnected from reality. 17 years without a real default cycle had left the market completely unprepared. The Citrini report's endpoint, June 2028. Unemployment at 10.2%. The S&P 500 down 38% from its October 2026 highs. A mortgage crisis building in the same prime borrower segment that was supposed to be bulletproof. Not because AI failed, because it worked. Now, is this going to happen? Nobody knows. The Citrini report was explicit. This is a scenario, not a prediction. A stress test, not a forecast. But here's why it matters. When this blog post hit the internet, Wall Street didn't dismiss it. Traders read it over the weekend and sold on Monday. Mastercard, Visa, American Express, DoorDash, they all dropped. Not because the report predicted the future, but because nobody could convincingly explain why the chain reaction it described wouldn't happen. Every step follows logically from the one before it. AI replaces workers. Workers stop spending. Companies lose revenue. Companies cut more workers. Mortgages crack. Credit markets crack, and the feedback loop has no natural break. The scariest financial scenarios aren't the ones that predict disaster. They're the ones that describe a perfectly logical sequence of events and dare you to find the flaw. A former Citadel analyst wrote a thought experiment on Substack. It described what happens if AI does exactly what every tech CEO promises it will, and it crashed the stock market. Not because it was wrong, because nobody could prove it was. Yes, if this changed how you think about AI, subscribe. Hidden Economics reveals the systems nobody else is talking about. Watch this next.